Jack Schwager, welcome to IGTV. Thank you very much for coming on board. Your books, obviously Market Wizards, are well renowned world over. You talk very much about fundamental analysis and also technical analysis. Another thing I noticed that's very close to your heart is leverage. Can you sort of go through what you see as the misconceptions of leverage itself?
Okay, well, leverage is one of the topics that is probably most misunderstood in the investment world by professionals as well as amateurs. And so there's this, ever since long-term capital, there's been this perception that leverage is risky and no leverage is no risk. And that leads to all sorts of absurdities because it depends really what's being leveraged. Now, let's say I'm a long-only stock guy and I got a 100% long portfolio. And I get nervous about the market and I say I don't want to have exposure. And I now say, well, I still like these stocks, and then there are second pick stocks I don't like as much. So instead of just getting out, I'm now going to use 100% leverage and go short 100%, okay? So I've now gone from 100% to 200% or 2 times leverage. However, my added 100% is all short positions offsetting my long. My net exposure has gone from 100% to 0. Now the way people look at it, they'll look at, oh, that's 2x leverage, that's risky. And before, it was not risky, which is totally absurd because before I had 100% exposure, now it's 0% exposure, net exposure to the market. So the key is, what is being leveraged? Leverage can sometimes be used to hedge, to actually reduce risk. And it's just absolute stupidity to not make a distinction between leverage that increases risk and leverage that reduces risk, but it is absolutely commonplace. Happens all the time. You get people as naive as looking at fixed income managers, and some fixed income managers have shorter term duration, some have longer term duration. So if you're going to look at a fixed income manager with short term durations and say, oh, he has 5 times leverage and this guy with long term durations has no leverage and therefore the 5x is more risky, that's insane because the risk in fixed income is dependent on the length of the securities, and it's very easy for a 1x leverage portfolio to be 10 times as risky as a 5x portfolio. So people have to understand leverage is not risk. Risk is a function of the underlying investment and the amount of leverage. But to look only at leverage or only at the underlying investment is you're only looking at half the equation. It's like saying, what is 2 plus x? Well, if I don't tell you what x is, you can't answer that question. But people answer that question. If 2 is risk, they'll say 2. Well, no, it isn't. You got to know what the x is. You got to know what the underlying investment is.
You also talk a lot about risk and managing risk and how risk works around. Can you just also talk about how investors can sometimes get lost with risk and also the better ways of actually using risk in your portfolio and as an investment opportunity?
Well, yeah, we're talking from an investor as opposed to a trader perspective at
Yes.
this point because it's a slightly different nuance.
Yeah.
So from an investor standpoint, the big mistake that investors make is to define risk as synonymous with volatility. Now that will work for some types of managers and it will serve as a reasonable proxy sometimes. It's come about to be a very common, almost routine substitution. You know, wherever you see risk, you put in volatility and that's the risk. And that's come out of the academic community where since you can measure volatility and it also has certain useful mathematical properties, it's become the proxy for risk. However, the problem with that is it doesn't work for a lot of investments. So you can have low volatility and high risk, and that's the big mistake traders make. So you had not traders, investors, traders too, but investors we're speaking about. So like for example in 2008, you had all these investors thinking they were in low volatility investments and finding out these so-called low volatility investments were losing more than the market, which was down 50%. Well, you know, how could that be? Well, the reason that could happen is because low volatility for many types of investments is not necessarily a reflection of the risk. That is because there are lots of investments where the normal pattern is they'll generate steady returns until there's a problem, you know, until there's an earthquake, you know, let's say in the markets, right? So you could live in Tokyo or wherever, and everything's fine. If you're not there during an earthquake, well, what's the problem, you know? But if you're there during an earthquake, it changes and the risk changes, and that's the same thing. The trouble with a lot of investments is they're like earthquakes. They only happen. The risk only happens sporadically. Now, if it's a very liquid investment, then the risk shows up routinely. But if it's a thing like credit investments, well, credit investments, they'll go through many, many years of being very, making general returns, and then there's a liquidity crisis and they'll lose horribly. Or selling options. Selling options will generate steady income in most cases, particularly out of the money options. However, when there's a sudden market break, they can lose exponentially. So you have all these investments which have sporadic risk, and people get fooled by looking at the track record and not realizing the track record they're looking at may not include the risk. It's like looking at the history of how safe is an area in Tokyo if you don't go back to the last earthquake. You can't answer that question.
Do you think the next stage of trading, more and more people using their phones and their tablets has made it less or more risky to actually trade?
Yeah, in those respects, I don't think it has changed much, really. There's probably more liquidity now than there used to be. There's also more professional traders, which make it more difficult to make money because there's more people. There's more smart players as a percent of total traders. So the analogy being, if you have a large lake and there's only a few large fish, they'll do extremely well. But if you keep on stocking the lake with more and more large fish, eventually they'll start starving. So there has to be, usually this gets to be some sort of balance in that type of environmental situation, and the same thing happens in the markets. But it is more difficult than it used to be, say, when I wrote the first Market Wizard books, where the people I was writing about were the minority and were able to make returns which are almost inconceivable today, simply because they were really, really good and smart, and there weren't that many professional traders. So nowadays that's gotten more difficult. But I think markets are still reflect human behavior, and there's still a lot of commonality.
Just one final question. Obviously, we're also now seeing more and more 24-hour news cycles. They're also bringing in more and more, therefore, risk into the market. Has you seen that there's been an extra variable in what we currently see in the market, for the fact that now news moves markets a lot more than probably it did because it's so much more instant?
Well, even pre-computer age, you still had news. During market hours, the market hours weren't 24 hours necessarily, but during that segment and during the off hours, the markets tend to be less active anyway, just naturally, unless there's a real news event. I don't know if that really changes it all that much. As far as fundamentals and market behavior go, typically, unless it's a surprise and it's something that's totally unexpected that happens, right? So that can have an effect. But if the news is an item which is kind of not a surprise of any sort, then it's probably already discounted, and you're as likely to get counter to the fundamental moves as moves consistent with what you would expect. And that fools people a lot of times, actually, whether it's overnight hours or daytime hours. It doesn't make a difference. People think that if it's bullish news, the market should go up, and then they're surprised if it goes down. Well, it's very common for it to go down when it's bullish, or vice versa, because the market's already discounted. In fact, the way using fundamentals for timing investments is actually useless, I think, unless you almost do it contrarianly. The only useful information to draw from fundamentals for timing is if the market behaves counter to what's anticipated. So if you have like a current Middle East situation going on, and let's say that deteriorates more and more, and there's more Iraqi oil refineries in danger and everything else, and the market sort of doesn't go up, that's probably really bearish. I mean, just as an example. I'm not predicting what's going to happen, but that would be a good example of the market not behaving as it should. And if that tells you anything, it doesn't tell you why is the market stupid. It's telling you that it's already discounted, or that the market is saying the supplies can be made up elsewhere, or whatever. In other words, it's really not surprising. So that's how you can use it in almost a contrarian way. Fundamentals from a longer term perspective, they can be useful for giving you longer term direction. But fundamental news for timing, if you're using it to go the same direction, odds are it's going to work against you.
Jack Schwager, thank you so much for joining IG.